Let's be honest, Stitch Fix has been a tough stock to own for a while now, but their latest earnings report just sent a major jolt through the market. So, the big question on everyone's mind is this for real? Is this the start of an actual turnaround? Today, we're going to dig into the numbers, unpack the strategy, and figure it out.
All right, let's dive right into the headline numbers. These are the figures that really caught the market's attention, beat all the expectations, and sent the stock flying. Okay, so it all starts with the top line, revenue. Stitch Fix brought in a cool $342.1 million. That's up over 7% from last year. And here's the kicker. That was $5 to $6 million above what analysts were expecting. That's a clear signal that sales are really starting to pick up speed.
Now let's talk about the bottom line, profitability. Their official loss per share was 5 cents. Now this wasn't a huge surprise. It was right in line with what Wall Street was forecasting. But you know what? In a market this choppy, just meeting expectations can be a solid win.
So what did the market think of all this? Well, investors absolutely loved it. The stock shot up more than 9% the very next day. And get this, it was on massive trading volume, like 3 times the usual amount. That's Wall Street giving a big, emphatic thumbs up.
Okay, so where's this growth really coming from? Is it just a fluke? Well, it's not just one thing. Management laid out a few key drivers, and we're going to unpack them right now.
Yeah, the CEO, Matt Baer, came out swinging with a really confident tone. Basically, his message was simple. Our turnaround plan is working, and we are actively stealing customers from the competition, even in this tough retail world.
So what's really lighting the fire here? It's that a bunch of things are finally clicking into place all at once. For starters, their current customers, they're spending more, a lot more, almost 10% more per order. That means more revenue from each client. And maybe the biggest steal of all? They've stopped the bleeding. After years of losing customers, the base is finally stabilizing. This is all powered by their AI and some smart bets on hot categories like denim and sneakers.
And this chart, wow, this really tells the whole story. I mean, look at this. The entire US apparel market is basically flat, growing at just 1%. Stitch Fix? They're growing over 7 times faster. This is the textbook definition of taking market share, and it's exactly why people are starting to pay attention again.
But, and this is a big but, all this awesome growth isn't coming for free. It involves a really important trade-off, and this right here became the central tension, the big thing analysts kept hammering on during the earnings call. What is this growth costing them?
So here's the fundamental trade-off they're making. To get that top-line growth, they're cranking up the ad spend and pushing into new product areas like footwear. The problem? Those new categories just aren't as profitable. The result? Sure, revenue is up, which is great, but their gross margin, that's the profit they make on every single sale, it took a pretty big hit, down 1.8 percentage points.
So management broke it down into 3 main culprits. The 2 big ones were, 1, just paying more for shipping, carriers hiking their rates, and 2, this strategic choice to sell more stuff like shoes. It helps them become more of a one-stop shop for your closet, but it definitely eats into the profit on each box they ship out.
Okay, so you've got this mix of good news on growth and maybe some concerning news on margins. How does that all shake out in the stock's performance? Let's zoom out and put it in context.
Over the last year, Stitch Fix has absolutely crushed its direct retail peers in the XRT ETF. I mean, it's not even close. That is a huge win. But it is lagging the wider consumer discretionary space, the one that has giants like Amazon and Tesla in it. So the takeaway is, Stitch Fix is winning in its own lane, but the market isn't quite ready to call it a top-tier growth stock just yet.
All right, let's bring it all home. What does all this mean for the future? This brings us to the final section, the next call, where we give you our prediction, our rating, and a potential trade idea.
Feeling good about that Q1 performance, management went ahead and raised their forecast for the whole year. They've nudged up their expectations for both revenue and profitability. That's a pretty strong signal that they think this isn't just a one-time thing. They believe the momentum is real. From here on out, it is all about execution. This is a prove-it story now, and investors are going to be laser-focused on 3 key milestones. 1, they have to hit these new, higher targets next quarter. 2, and this is the big one, they have to prove they can actually start adding new clients again by Q3. And 3, they need to show that this dip in margins was just a temporary investment, not the new normal. So, where do we land on this? What's our final call? Look, you've got revenue picking up steam, you've got clear evidence they're taking market share,
and that customer churn has finally stopped. Because of all that, we're initiating coverage with an outperform rating. We think the turnaround story is credible and that the potential upside here outweighs the risks.
And that leads us right into our trade idea, and it all comes down to that massive catalyst in Q3, client growth. Seriously, if they can prove they're adding customers again, that could completely rewrite the story for this stock and cause a major re-rating. We think that kind of news could make the stock jump in a big way, and a long call option is one way to position for that specific positive outcome.
And of course, just a reminder, this is not financial advice.